हमें बनाते हैं the largest settler of insurance claims in India, ICICI Lombard.
All right, welcome back to Closing Trades. In a bit, we'll also get in Devin Choksi to speak about the fundamentals. Let's start off, of course, with getting in the FNO strategies. It's FNO expiry week. Amit Trivedi, Director of FinStream Financial Advisors, joins us right now on the show. Amit, quick one on how you are playing the index right now. 3 days to expiry, but of course, the budget also coming on that day.
Good afternoon. So broadly, what we are experiencing is that markets are moving in that broad range of around 5850 to 5880 and plus minus 20-30 points here and there beyond that range. Predominantly, everyone is anticipating and how the budget will plan out. That is a big event risk and that can sway markets anyway. So we think markets can go down to as low as 5600 and on the upper side it can go to as high as around 6050, 6100 levels. Also, what is happening interestingly is option IVs have started increasing. So what was available at around 12.5% Nifty options have moved to around 25%. So you have a straddle of 5900 which is available at around 100 rupees. So we think investors can buy for the budget event the 5900 straddle for around 100 rupees. This can become as high as around 130 to 150 on the budget day.
Fair enough. Use the straddle strategy for the index to play the event risk on budget. We'll talk to you about stock-specific trades as well, Amit, in just a bit. But first, let's introduce Devin Choksi as well, MDKR Choksi Securities, for his perspective on the market. Aside of the index, your comment really on the huge mid-cap sell-off that we saw in today's session, Devin, how do you rationalize it?
Yes, good afternoon. Well, I think it's difficult to predict this particular market. Today's fall in the mid-cap has been largely driven out of some fallout which has happened, I think, with the people who are operating into the markets. And probably I think their stocks have come in for a last sale. As far as I think the market is concerned, I think it basically got triggered with a substantial amount of sale orders coming in from their brokerages, who had funded their positions to these operators. So I think it's very difficult, since these positions stay outside the market environment, probably whenever the attack comes in, then the investors come to know about the actual impact. And that's where the things have gone down. Fortunately, this time around, the sell-off has not happened due to the promoters' margin call through the lenders. That's not happened, fortunately, this time around. So I think the situation is largely more of a structural issue, as I call it, because the market is continuously having this kind of a situation time after time, wherein the positions which are created, leverage positions which are created outside the market, they turn into the market as and when the lenders become jittery about the lending that they have done. It is simply understood that the regulators stroke exchanges need to bring up a product into the market where the lending and borrowing should happen into the markets, so that it becomes much more productive kind of an environment vis-a-vis the one in which we are operating currently. Really unfortunate, but the carnage is damaging, definitely very, very damaging. Not many companies are fundamentally weak. If you look at the valuations, many of the companies with the business model, they're quoting at around sub 5 Ps. So I don't think that one should be getting disturbed with the fundamentals, but it is largely due to the market technicals which are basically damaging the confidence of the investors.
Then which one out of these stocks would you believe is probably more fundamentally sound, and you would probably even look at it? Because almost everything has been hammered out of shape. Would you be brave enough to go out and buy any of these?
Well, we like few companies in the businesses. One is Heroes International, that is the victim of the situation. Core Education, once again a victim of the situation. We like those businesses. Certainly, they demand merit at current price. I'm not saying that we'll go out and buy everything together, but they demand merit at this point of time. Unfortunate part is that some of these mid-cap companies, they don't have any takers, because neither the local investors nor the overseas investors, they have appetite for some of the mid-cap companies, given the kind of a trading that they do. As a result of which, they are completely neglected. But those who are value investors, for them, you may find that some of these companies could offer a good amount of opportunity, because as and when the climate turns normal, which is not happening in last 3-4 years, of course, but as and when it turns normal, going forward, these are the companies which could possibly give little better appreciation. So one will have to play with some of the known plays, known names where the business fundamentals are relatively more comfortable than otherwise. I think where you can probably make money out of this kind of opportunity which is available in the market today.
Amit, the one which is holding up the index today, the pack that is holding up the index today is the IT pack. What do you do with one, an Infosys, and two, maybe a choice between HCL Tech and a TCS? Any strategies here?
Yeah, so what has happened is because of the general underperformance of the market, IT has started outperforming the broader markets that we have. So hence you have Infosys and TCS all moving up around 1.5–2% today. We think this outperformance should gradually continue over the next 3–4 months also as we get into more uncertainty and budget around the corner. So we think investors can buy these stocks on dips. On options, predominantly, the IVs have gone up to around 27–28%, for example, for Infosys. So not in this series, but maybe sometime once the budget is over, you may go for a ratio trade in Infosys. So you can buy, for example, in March, 2,900 strike calls of Infosys and sell 2–3,000 strike calls. So if there is a marginal upside, you will benefit over there. Similarly, for HCL Tech, we have seen that the stock comes down to around 670–680 levels and bounces back to around 720 levels. So when it comes down to around 680–690, you can go and sell puts of 640 strike at around 3–4 rupees in the March series and eat away the premium, because the stock should typically move up from 660 levels to 700 back levels.
What about a position and trade on the Bank Nifty, because that will be also very keenly watched out for on budget day?
Yes. So for example, for this particular series in particular, we think buying options is a better strategy because of the event risk of budget, which can sway markets heavily on the budget day, which incidentally is also the expiry day. So you have, like for example, the 12,100 strike call plus put available at around 225 rupees. So we think in a day or so, if it comes down to around 210, 215 or even at 225, you can buy the straddle, which is 12,100 call and 12,100 put. If market or Bank Nifty moves anywhere between 2 to 3%, which is typically 240 to 360 points on budget day, you can make around 50 to 100 rupees returns on this particular strategy.
I guess you agree, you're playing the expiry with options as opposed to plain vanilla futures. Is that a better trade?
That for me, yeah. Yeah, see, actually we haven't been having any kind of positions on the index side for the last couple of days. After I think Friday, after last week's fall, I think Friday we saw very a small kind of consolidation. And while the IVs have shot up, I think it's two-edge kind of squad with the number of events stacked up along with expiry. So I think we are not playing much on the options side. But what is happening here, and I've been emphasizing on this, is that the breadth has been weak, and that's where I think selling or sell signals are seeing a lot of follow-up in the individual market, individual stock market. So I think we are taking it stock by stock, and I think trading that way.
Okay. Maybe just a few seconds, actually, bang on time. Let's get in the trading ideas at 2:55. We'll actually even get in Amit to maybe give us an idea, but start off with Ashwini and Mitesh. Ashwini, what are you recommending at 2:55?
Well, LIC housing, that got smashed up quite a bit, and today it's gapped up and held on to its gap. So this is a buy with a stop about 244, and look for at least a retest of its 200-day moving average, which is around 260.
Mitesh, what about you? What is it that you're recommending?
There's two ideas. One is a buy on Lupin, but that's a buy above 614, and I think I've been waiting for that breakout now. So once it starts trading above that, buy with stop below 600, look for target of around 640. The other one is a sell on IndusInd Bank, but again I think here I would like to see the stock start trading below 423. I think today's low is around 423.5. So once it starts trading below 423, keep a stop at about 434 and look for a target of around 405 to about 402 on the downside.
Amit, come to you. Any strategy that you would recommend? One of your top trades, essentially?
Yeah, I think what we can do is, as I said, buying options is basically the right way of approaching the market. But if someone wants to make some premium out of it, you can go and sell deep out of the money calls, for example. So, for example, Tata Steel, after results, has corrected from around 380 to around 360 levels. Today, I think it's around 365 levels. So one can go and sell 400 strike calls of Tata Steel which is trading at around 0.55 or 0.6 rupees. So you make around 550 rupees to 600 rupees on a margin deployed of around 30,000. So that's around 1.5% return. And Tata Steel you will start making losses if Tata Steel rallies beyond 400, which is like more than 11%, 12% from current price of 365 levels.
Okay, Sadbhav, getting a 700 crore order. It's not a very liquid stock, but up close to 4.5 or 5% in trade as a result of that. It's a big order, yes, for the order-starved industry, and the companies had okay, but the order-starved industry. So 3.5% at 112, mind you, not a very liquid stock. Just keep that in mind. Let's take a break. We come back with fundamental ideas from Devin Choksi as well. Hear out as we do that, Nirmal Jain, chairman of IIFL, who is confident that the FM can deliver a good budget ahead of election.